a young investor eager to understand the secrets of stock market success, hears about Warren Buffett, the world's most famous and successful investor. How did he build his fortune? What makes his strategy different from others who take big risks? The Warren Buffett way explores the principles behind Buffett's success. He believes in buying strong companies, holding them for the long term, and avoiding unnecessary risks. This book breaks down his investment approach in a simple and practical way, making it easy for anyone to learn and apply his methods to build lasting wealth. Chapter 1: The World's Greatest Investor. Warren Buffett is considered the greatest investor of all time, not because of luck, but because of his disciplined, logical, and patient approach to investing. Unlike many traders who try to time the market or chase quick profits, Buffett focuses on long-term success. He believes in buying strong businesses, holding on to them for years, and letting compounding do its work. His investment strategy is based on finding companies with strong fundamentals, businesses that have stable earnings, reliable management, and a competitive advantage. He avoids risky speculation and does not invest in things he does not understand. This careful approach has helped him turn Berkshire Hathaway from a struggling textile company into one of the world's most valuable corporations. Buffett's success story is not about following trends, but about making smart, well-researched decisions. He sticks to simple principles: buy undervalued companies, stay patient, and invest with a long-term mindset. His ability to remain calm during market downturns and focus on the bigger picture has set him apart from other investors. His journey proves that wealth is built over time with knowledge, discipline, and a clear strategy. Chapter 2: The Education of Warren Buffett. Buffett's passion for investing began at a young age. As a child, he was fascinated by numbers and business, selling newspapers, chewing gum, and even buying pinball machines to place in local barbershops. His early experiences with money taught him valuable lessons about profit and risk. His formal education in investing started when he discovered Benjamin Graham, a professor and author of The Intelligent Investor. Graham's value investing philosophy shaped Buffett's early thinking. He learned to buy stocks that were priced lower than their true worth. Excited by these ideas, Buffett attended Columbia Business School to study under Graham, who became his mentor. However, Buffett soon realized that Graham's method of simply buying undervalued stocks had its limitations. He started focusing not just on cheap stocks, but on high-quality businesses with strong long-term potential. This shift in thinking was influenced by Charlie Munger, Buffett's longtime business partner. Munger taught him that a great company at a fair price is better than a mediocre company at a cheap price. Buffett's education was not just about books and theories. He gained real-world experience by analyzing businesses, learning from mistakes, and refining his investment strategy. His ability to blend Graham's principles with a focus on high-quality businesses became the foundation of his success. This learning process helped him develop the investment style that made him one of the richest and most successful investors in history. Chapter 3: The Psychology of Investing. Warren Buffett highlights the significant role that emotions play in investing. Fear and greed are two powerful emotions that can lead investors to make irrational decisions, buying stocks during periods of market hype or selling them in panic during downturns. Buffett stresses the importance of making investment decisions based on logic, research, and a long-term perspective, rather than being swayed by the market's short-term fluctuations. He advises that the best investors are those who remain calm and focused on the future, avoiding the emotional roller coaster that can cloud judgment. A key concept is emotional discipline. Buffett believes that the stock market rewards patience. Those who are able to control their impulses and resist the urge to react to market swings often come out ahead. In his view, the stock market essentially transfers wealth from the impatient to the patient. Therefore, sticking to a clear strategy and maintaining a long-term mindset is essential for success. Buffett also introduces the idea of Mr. Market, a metaphor for the irrational behavior of the stock market. Mr. Market offers to buy or sell stocks at different prices every day, depending on his mood, sometimes overly optimistic, other times overly pessimistic. The key takeaway is that investors should not be swayed by Mr. Market's mood swings, but instead focus on purchasing stocks at attractive prices when the opportunity arises. Buffett's success largely comes from his ability to keep emotions in check, remain rational, and stick to his strategy even during market volatility. Understanding the psychology of investing is just as important as financial analysis, as it helps investors make decisions that are less influenced by fear or greed, ultimately leading to better, more rational investment choices. Chapter 4: The Science of Investing. Warren Buffett views investing as both an art and a science. The science of investing involves using data, analysis, and logical reasoning to make informed decisions. While there is an element of intuition in investing, the scientific side relies on thorough research and understanding the true value of a company. Buffett emphasizes the importance of financial statements such as income statements, balance sheets, and cash flow statements. These documents offer vital insights into a company's financial health. Successful investors know how to analyze these statements to determine whether a company's stock is fairly priced, undervalued, or overpriced. This scientific approach helps avoid emotional decision making and allows investors to focus on the facts. A critical concept is understanding a company's intrinsic value, which is its true worth based on future cash flows and overall financial health, rather than its current stock price. Buffett believes the stock market often misprices companies, creating opportunities for disciplined investors to buy undervalued stocks. The margin of safety principle is another important concept. By investing in companies priced below their intrinsic value, investors create a cushion to protect against potential losses. This method helps reduce investment risks and maximizes potential returns. Buffett's success is largely due to his ability to apply the science of investing, combining financial analysis with a deep understanding of business fundamentals. This approach to evaluating companies and determining their true worth sets great investors apart from others. Chapter 5: The Art of Investing. Investing is not just about numbers and formulas. It also involves judgment, intuition, and experience. While financial analysis provides a solid foundation, the art of investing comes into play when evaluating a company's management, future prospects, and the overall market environment. A key aspect of investing is identifying businesses with a sustainable competitive advantage, often referred to as a moat. These companies stand out due to their unique products or services that differentiate them from competitors. Developing the ability to recognize companies with strong long-term advantages is a skill that comes with experience. Another important element is understanding the psychology of the market and the behavior of other investors. The market is often driven by emotions like fear and greed, leading to irrational price movements. Great investors are those who can remain calm during times of market hysteria and avoid following the crowd. Patience and discipline are also essential for successful investing. The art of investing requires the ability to wait for the right opportunities and avoid rushing decisions. This comes from experience and a deep understanding of the companies in which one invests. Ultimately, the art of investing is about balancing logical analysis with intuition, patience, and an understanding of market psychology. By combining these elements, investors can make smarter, more strategic decisions. Chapter 6: The Business of Investing. Investing is not just about buying stocks and making profits. It is also a business in itself. The process involves understanding the broader market, managing risks, and making strategic decisions that align with long-term goals. Successful investors treat investing like a business, focusing on making informed decisions and being disciplined in their approach. One of the main elements of the business of investing is risk management. A smart investor understands the risks involved in every investment decision and works to minimize them. This includes diversifying portfolios, studying market trends, and investing in businesses with solid fundamentals. Another crucial aspect is the importance of managing capital effectively. Just as in any business, investors must allocate their capital wisely, choosing where to invest and when to hold back. Capital should be allocated to opportunities with the highest potential return based on careful analysis. The business of investing also involves understanding the role of competition in the market. Just as business face competition in their industry, investors face competition from other investors in the market. The ability to outthink and outperform others is an important part of the investment process. Finally, treating investing as a business means focusing on long-term results rather than short-term gains. Successful investors prioritize building wealth over time, sticking to their strategy, and staying disciplined even during market fluctuations. By viewing investing as a business, investors are more likely to approach it with a strategic mindset, making well-thought-out decisions that lead to lasting success. Chapter 7: Investing guidelines, business tenets. Successful investing relies on clear guiding principles that help investors stay disciplined and make informed decisions. Key tenets for smart investing include focusing on businesses with strong and sustainable competitive advantages or moats. These companies have something unique, such as brand recognition or patents, that allows them to remain profitable over time, even in competitive markets. Identifying companies with a durable moat is essential for long term success. Another critical tenet is to invest in companies with solid and trustworthy management teams. Effective leadership is vital for a company's long term success, and investors should seek out leaders who are honest, capable, and focused on creating value for shareholders. Strong management can significantly influence a company's performance, making leadership an important factor in investment decisions. Investing in companies with predictable and understandable business models is also vital. Investors should only invest in businesses they understand thoroughly, as this reduces the risk of poor decisions. This principle ensures that investors know exactly what they're investing in and why it is likely to be profitable. A long term perspective is another key principle. Investors should remain patient and avoid being distracted by short term market fluctuations. Instead, the focus should be on the long term growth and profitability of the company. This helps prevent impulsive decisions based on temporary market volatility. Finally, discipline and risk management are crucial. Investors should avoid overpaying for stocks and ensure that every investment has a margin of safety. This risk-averse approach minimizes the chances of significant losses while maximizing potential returns. By following these investing guidelines, investors can make smarter decisions, avoid common mistakes, and achieve long-term success. Chapter 8: Investing Guidelines and Tenets. Strong management is a key factor in the success of any business, and when making investment decisions, it is essential to assess the quality of a company's leadership. Effective management drives the company's performance, creates value for shareholders, and ensures the business remains competitive. One important guideline is to look for management teams that are shareholder-oriented. Great managers prioritize the interests of their shareholders, making decisions that lead to sustainable growth and long-term value. They focus on improving the company's performance rather than seeking short-term gains or personal rewards. Integrity is another crucial element. Investors should look for management teams with a track record of honesty and transparency. Trustworthy leaders who communicate openly with shareholders and follow ethical business practices are key to long-term success. Misleading statements or unethical behavior can damage a company's reputation and harm its performance. A good management team also demonstrates a strong ability to allocate capital wisely. Effective capital allocation involves reinvesting profits in projects that create the highest return for shareholders, as well as making smart decisions regarding acquisitions, debt management, and dividends. Managers who consistently make sound capital allocation decisions can lead a company to greater success and stability. Another important factor is the ability to adapt to changing market conditions. Successful management teams are flexible and able to navigate through challenges such as economic downturns or industry disruptions. They are forward-thinking and make strategic decisions that ensure the company remains resilient in the face of uncertainty. Finally, strong management teams are focused on building a sustainable, long-term business. Investors should look for companies where management is focused on creating lasting value rather than achieving short-term financial goals. This long-term vision often leads to better decision-making and stronger financial performance over time. By focusing on management tenets, such as integrity, capital allocation, and a long-term vision, investors can identify businesses with strong leadership, which is a critical factor in successful investing. Chapter 9: Investing Guidelines, Financial Tenets. Financial health is a cornerstone of any successful investment strategy. Evaluating a company's financial strength is essential in determining whether it is a good investment. Strong financial tenets help guide investors toward businesses that are well managed, resilient, and capable of delivering consistent return. One of the key financial principles is to focus on companies with strong, consistent earnings growth. A track record of steadily increasing profits is a sign of a well-run business. This stability in earnings provides investors with confidence that the company will continue to perform well, even during market fluctuation. Another important financial tenet is to look for companies with a solid balance sheet. A healthy balance sheet means the company has manageable levels of debt and enough assets to cover its liabilities. This financial stability ensures that the business can weather economic downturns and continue to operate without being overly reliant on borrowed funds. Companies with too much debt are riskier investments because they may struggle to meet their obligations during difficult times. Cash flow is another critical factor in evaluating a business's financial health. Companies that generate strong, consistent cash flow have the financial flexibility to reinvest in their operations, pay down debt, or distribute dividends to shareholders. Cash flow is often seen as a more reliable indicator of financial health than earnings, as it shows the actual money coming into the business, which is essential for ongoing growth and stability. Investors should also pay attention to a company's return on equity, ROE, a key metric that measures the profitability of a company relative to shareholder equity. A high ROE indicates that a company is efficiently using its capital to generate profits. Companies with a consistently high ROE are often better investments as they demonstrate strong management and the ability to create value for shareholders. Lastly, the concept of a margin of safety is crucial when evaluating a company's financial standing. A margin of safety refers to the difference between a company's market price and its intrinsic value. Buying stocks at a price significantly below their intrinsic value provides a cushion against unforeseen risks and market fluctuations, helping protect against potential losses. By following these financial tenets, focusing on earnings growth, financial stability, cash flow, ROE, and a margin of safety, investors can make informed decisions that minimize risk and maximize the potential for long-term success. Chapter 10, Investing Guidelines, Value Tenets. Value investing is centered around buying stocks that are priced below their intrinsic value, offering a margin of safety for investors. These value tenets focus on identifying opportunities where the market has undervalued a company's stock, providing a chance to invest in quality businesses at a discount. A core value tenet is the focus on buying businesses, not just stocks. Successful investors look for companies with strong fundamentals, solid earnings potential, and a track record of success, rather than trying to time the market or speculate on short-term price movements. The goal is to find businesses that are undervalued by the market but possess long-term growth potential. Another important tenet is the concept of a margin of safety. This principle suggests buying stocks at a price significantly lower than their intrinsic value, creating a cushion to protect against potential losses. A sufficient margin of safety ensures that even if a company's performance isn't as strong as expected, the investment is still likely to generate positive returns over time. Value investors also focus on companies with predictable earnings and strong cash flows. Companies with stable and consistent earnings are more likely to withstand market volatility and deliver long-term value. Investors should prioritize businesses with a proven ability to generate consistent profits and cash flow, as these indicators signal financial strength and stability. Long-term focus is another key tenet of value investing. Rather than seeking short-term gains, successful value investors hold on to their investments for the long haul, allowing the market to eventually recognize the true value of the company. This patient, disciplined approach is essential in achieving sustainable growth and capital appreciation. Finally, the principle of contrarian investing is often employed by value investors. This involves buying when others are fearful and selling when others are overly optimistic. Market inefficiencies often create opportunities for value investors to purchase high-quality companies at a discount when market sentiment is overly negative. By following these value tenets, focusing on businesses, ensuring a margin of safety, prioritizing consistent earnings, maintaining a long-term focus, and practicing contrarian investing, investors can identify undervalued stocks that offer significant growth potential and reduced risk. Chapter 11, The Psychology of Money. The psychology of money plays a crucial role in investing success. Emotional decisions often lead to poor outcomes, as fear, greed, and impatience can drive people to make irrational choices in the market. Understanding the psychological factors that influence financial behavior is key to becoming a disciplined and successful investor. One of the most important psychological principles is the ability to control emotions. Investors often let fear and greed guide their decisions, leading them to buy when prices are high out of excitement or panic sell during market downturns. Successful investors, however, maintain a calm, rational approach, avoiding emotional reactions to short-term market fluctuations. Another psychological factor is the tendency to overconfidence. Many investors believe they can predict market movements, which often leads them to take excessive risks or make frequent trades. Overconfidence can result in large losses, especially when markets behave unpredictably. Humility and an understanding of the limitations of one's knowledge are crucial to making sound investment decisions. The concept of loss aversion also plays a significant role. People tend to feel the pain of losses more acutely than the pleasure of gains, which can lead to overly cautious behavior. Investors may hold on to losing stocks for too long, hoping they will rebound, instead of cutting their losses and reallocating capital to better opportunities. Successful investors understand that losses are a natural part of investing and focus on managing risks rather than avoiding them altogether. Another psychological challenge is the herd mentality. When everyone is buying or selling based on popular trends or news, investors often follow the crowd without conducting independent research. This can lead to buying overvalued assets or selling undervalued ones. Successful investors, however, are willing to go against the crowd, making decisions based on their own analysis rather than following market sentiment. Finally, patience is a critical psychological trait for successful investing. Many investors struggle with the idea of waiting for long term gains, opting instead for quick profits. Successful investors, however, are patient and understand that wealth is built over time through consistent, disciplined investing. By understanding the psychology of money, investors can better control their emotions, manage risks, and make decisions that lead to long term financial success. Chapter 12: The Unreasonable Man. The concept of the unreasonable man is rooted in the idea that true innovation and success often come from those who refuse to accept conventional wisdom. While society may expect people to follow the rules and conform to standard practices, the most successful individuals and investors are often those who challenge the status quo and think differently. The unreasonable man is someone who does not follow the herd. In investing, this means making decisions based on independent thinking and a deep understanding of value, rather than following popular trends or market sentiment. Such individuals are not afraid to go against the crowd, even if it means being considered unreasonable or unconventional. This principle also highlights the importance of confidence in one's own judgment. The unreasonable man trusts their research and analysis even when others doubt or criticize their decision. This independence allows them to spot opportunities that others overlook and take advantage of situations where others see risk. However, being unreasonable does not mean being reckless. The unreasonable man still uses careful analysis and considers risks, but they do not shy away from making bold decisions when they believe in the potential for long-term success. This ability to act decisively and without fear of failure often leads to exceptional outcomes. In the world of investing, the unreasonable man is able to see value where others do not. By following their own convictions and avoiding the trap of herd mentality, they create unique opportunities for growth and wealth that others might miss. The lesson here is that great investors are often those who think differently, challenge assumptions, and make decisions based on their own principles rather than conventional wisdom. The unreasonable man represents a mindset of boldness, independence, and a willingness to take calculated risks. This approach to investing can lead to significant rewards, as it encourages looking beyond the obvious and striving for innovative solutions and long-term value.